Hey everyone, welcome back. Markets don't move randomly. They move in patterns, driven by behavior, structure, and narrative. Today we're going to talk about something that looks like opportunity on the surface, but completely changes shape once you experience it from the inside. We're going to break down the BlockDAG experience that first gained massive attention around January 2024 and extract the structural lesson behind it so situations like this can be understood better in the future. This is purely my personal perspective based on observation and experience. It always starts the same way. A project starts gaining attention. In this case, BlockDAG in its early phase around January 2024. A presale structure that feels simple, almost intuitive. Enter early, wait for listing, and exit when the market opens. On the surface, it looks clean. Early entry, early advantage, early profit. And that is exactly why it attracts attention so fast. Not because people are reckless, but because the structure appears aligned with how a normal market cycle should behave. Lower entry price, strong narrative around listing, and the assumption that once trading begins, price discovery will function in a balanced way. That creates a very strong perception. This feels like an early stage opportunity. Inside the investor's mindset, the flow becomes extremely linear. Buy before listing, wait for the market to open, and exit at the first available liquidity window. Everything feels structured, predictable, almost mechanical. But there is one assumption that rarely gets tested properly. Do all of these conditions actually exist at the same time, exactly when the market opens? Then listing day arrives, and reality starts to behave differently. Liquidity turns out to be extremely thin. Price movement becomes unstable from the very first moments. And instead of a clean open market, what appears is a fragile environment where execution is not as smooth as expected. The structure that was assumed to be open is not fully open. Then something subtle happens. As price begins to break down, the narrative starts to shift from momentum to stabilization, from growth expectation to anti-dump protection, from market behavior to strategic justification of conditions. But the market itself never responds to narratives. It responds to structure. And when liquidity is weak, when buying pressure is not balanced, and when exit conditions are not truly synchronized, price does not simply correct. It breaks, fast, deep, and without structural support underneath it. At a certain point, the structure changes again. Access that was previously unclear starts to reopen. Trading becomes available again, but not at the same timing, not at the same price, and not under the same conditions. By then, the market has already moved far beyond the initial expectation window. Value has already repriced itself elsewhere. The presale continues, even at levels far below where the initial listing structure collapsed. From the outside, it can still appear like another opportunity forming, but from a structural perspective, it reveals something more important in hindsight. The exit window that was assumed at the beginning was never truly synchronized with real market conditions. And this is where something important needs to be acknowledged, not just analytically, but humanly. Many early investors have now been in this for almost 2 years, and for a large part of them, the emotional reality is no longer about expectation or hype. It is about being stuck between two outcomes that feel equally difficult. At current conditions, the token is not just down. It is structurally down around 99% from perceived highs. In that kind of environment, the decision is no longer simple. Selling means realizing a near total loss. Holding means uncertainty that may or may not recover, with no guarantee that capital will ever return to previous levels. And that's the part that validates what many early participants are actually feeling right now. It is not just disappointment. It is a state where both available choices carry pain, just in different forms. After wading through cycles, narratives, and expectations, the market is now in a place where stability does not mean strength, but rather a locked-in lower range that no longer reflects the original assumption of opportunity. And this is where the real lesson from BlockDAG becomes important, not emotionally, but structurally. Before entering any presale again, the focus cannot be on hype, narrative, or projected upside. The focus has to shift towards structure. There are only a few questions that actually matter, and this is where most investors miss the real filter. First, you don't evaluate hype or community strength. You evaluate whether liquidity at listing is strong enough to support real price discovery and whether that liquidity is actually aligned with tokenomics. Because liquidity alone does not define stability. Tokenomics determines how that liquidity will behave. If supply distribution is heavily front-loaded, if unlock pressure is concentrated early, or if large portions of tokens can enter circulation while liquidity is still thin, then the structure is already imbalanced before trading even begins. Second, you look at whether trading access is truly open at the exact moment of listing. Not delayed, not phased, not partially restricted. Any deviation from immediate access already changes the exit assumption. Third, you ignore price storytelling and focus on real depth. Because declared pricing without real liquidity backing is not structure, it is perception, and perception does not hold price. Fourth, you evaluate whether exit conditions are symmetric, meaning if early participants enter at TGE, can they exit under the same conditions at TGE? If this symmetry does not exist, the system is already structurally biased, even if it looks professional externally. And finally, you observe post-collapse behavior. If presale continues aggressively after a major market breakdown, it indicates that capital inflow is not dependent on fair price discovery, but on continuous participation regardless of prior market outcome. If even two of these signals are unclear, the structure has already given its answer. You don't need prediction. You don't need perfect timing. You only need structural clarity before entry, because in systems like this, the real risk is never just volatility. It is entering a market where exit exists in theory, but fails in practice at the moment it matters most. And once that is understood, the objective is no longer to chase every opportunity. It becomes much simpler. Only participate when liquidity, tokenomics, and listing mechanics confirm that exit is actually functional at the exact moment the market opens. This is my personal perspective and interpretation based on the BlockDAG experience. If you find this kind of breakdown useful and you want more structured market investigations like this, you can support the channel by liking, commenting, and subscribing to Bias Positive Digital Rise.